Every year, your money becomes worth less. Not because you spent it, not because you failed, but because the system is designed that way. In the next 30 minutes, you'll discover why money loses value over time, who benefits from this process, and why most people never question it. The silent loss. Every year, something strange happens to your money. It becomes worth less. Not suddenly, not dramatically, but quietly. So quietly that most people never notice it happening. They feel it, but they don't understand it. The illusion of stability. When you look at money, it feels stable. $1 today looks exactly like $1 10 years ago. The number in your bank account doesn't change, but value is not the same as appearance. Money can stay the same in number while losing its power. What purchasing power really means. Purchasing power is simple. It is how much your money can buy. Years ago, the same amount of money could buy more. More food, more rent, more services. It buys less, not because products became better, not because people became greedy, but because the system slowly changed the value of money itself. A simple example. Imagine you save money. You don't spend it. You don't waste it. You do everything right. And yet, after several years, you realize that your savings buy less than before. You didn't lose money. Money lost value. Why this feels invisible. This loss doesn't happen overnight. It happens gradually. A few percent each year. Small enough to ignore, large enough to matter over time. This is why people don't panic. They adapt, and adaptation hides the problem. Why people blame themselves. When money feels tight, people blame their decisions. They think, I should earn more. I should save harder. I made mistakes. Rarely do they question the system itself. But the system is doing exactly what it was designed to do. Money is not neutral. Money is not a passive tool. It is shaped by policies, incentives, and structure. And in the modern system, money is designed to slowly lose value over time. This is not an accident. It is intentional. The quiet question: if money loses value every year, who benefits from that loss, and who pays the price? To answer that, we need to understand inflation, not as a headline, but as a mechanism. Inflation, explained simply. Inflation is a word everyone hears, on the news, in conversations, in explanations for rising prices. But few people truly understand what it means. Inflation is not just about expensive products. It is about the value of money itself. What inflation really is. Inflation is the gradual increase in prices over time. But more importantly, it is the gradual decrease in purchasing power. When inflation happens, each unit of money represents a smaller share of the economy. The number stays the same. The value does not. Why prices rise together? It often feels like everything gets more expensive at once. Food, housing, energy, services. This is not coincidence. When more money enters the system, prices adjust to absorb it, not immediately, but inevitably. The common misunderstanding. Many people believe inflation is caused by greed. They think, Companies raise prices. Sellers take advantage. Consumers suffer. But greed has always existed. Inflation has a different cause. It is tied to how money is created. Where new money comes from. Most new money is not printed. It is created digitally. When banks issue loans, new money enters circulation. Mortgages, business loans, consumer credit. Each loan adds new money to the economy. Why inflation is slow? Inflation is not instant. New money spreads gradually. It moves through banks, corporations, asset markets, and finally consumers. By the time it reaches everyday prices, its effects are already embedded. Who feels inflation first? Not everyone feels inflation at the same time. Those closest to new money, banks, investors, large institutions, benefit early. Those on fixed incomes feel the impact later. This creates imbalance. Why inflation is considered normal. Central banks often target inflation, not zero, not negative, a small, steady rate. Why? Because inflation encourages spending and borrowing keeps the system moving. The trade-off, low inflation, reduces purchasing power, punishes saving, encourages risk, but it also supports debt, fuels growth, stabilizes the system. This trade-off is built into modern money. Why inflation never stops. Once inflation exists, stopping it completely becomes dangerous. Deflation increases the real value of debt, and high debt is everywhere. So the system chooses slow loss over sudden collapse. Who benefits first? When new money enters the economy, it does not reach everyone equally. This is the most important detail most people never learn. Money does not spread evenly. It moves in a specific order, and that order determines who wins and who falls behind. The first receivers. The first receivers of newly created money are banks, financial institutions, large corporations, governments. They access money before prices rise. At this stage, money is still strong. Assets are cheaper. Opportunities are larger. The advantage of timing. Timing matters more than effort. Those who receive money early buy assets, invest, expand. By the time money reaches workers and consumers, prices have already adjusted. The advantage is locked in. Why assets rise faster than wages. Asset prices respond quickly to new money. Stocks, real estate, investments, wages do not. Salaries adjust slowly, often too late. This creates a growing gap between those who own assets and those who rely only on income. The quiet transfer of value. Inflation quietly transfers purchasing power from savers, fixed income earners, cash holders to borrowers, asset owners, institutions. No laws are broken. No headlines are needed. The transfer happens automatically. Why this feels unfair. People feel the imbalance, but cannot explain it. They work harder, save more, yet feel left behind. This frustration is not emotional. It is structural. Why crises don't change the system. Financial crises seem like failures, but they rarely change the structure. After each crisis, more debt is created. More money enters the system. The cycle continues. The system survives by expanding. Who pays the cost? The cost is paid by those with limited access to credit, little exposure to assets, no protection against inflation. They do everything right and still fall behind. The core truth. This system does not reward effort alone. It rewards position. Where you stand in relation to money creation matters more than how hard you work. What this means for you: understanding how money loses value does not make you wealthy overnight, but it changes how you think. And thinking differently changes outcomes over time. Why this is not about panic. This knowledge is not meant to scare you. The system is not collapsing tomorrow. Money will still work. Banks will still operate. But understanding reality removes false expectations. And false expectations are expensive. Income is not enough. In a system where money loses value, income alone is not protection. Earning more helps, but it does not solve the core issue. What matters is how your money behaves over time, not just how much you earn today. Saving without awareness. Saving feels responsible, and it is, but saving without understanding inflation slowly reduces purchasing power. Money sitting still falls behind a moving system. This is why many people feel they are always catching up. Debt is a tool, not a rule. Debt is neither good nor evil. It is a tool. Used consciously, it can accelerate opportunity. Used blindly, it becomes a burden. The difference is understanding the system you are operating in. Time is the real advantage. Time changes everything. Inflation works slowly. Compounding works slowly. Those who understand this stop chasing short-term wins. They focus on positioning, not perfection. Awareness changes behavior. When you understand how money works, fear decreases, panic fades, decisions become calmer. You stop reacting and start planning. This alone is a competitive advantage. The real choice: you cannot escape the system. Participation is mandatory, but blindness is optional. You can move through the system aware of its rules instead of fighting illusions. Final perspective: money losing value is not a bug. It is part of how the system functions. Once you accept this, you stop asking the wrong questions and start asking better ones. Closing: the most important step is not action. It is understanding. Because in a system designed this way, clarity is power.